Good afternoon, everyone. Hope you're all doing well. Very welcome to our Friday run through to wrap up the week in terms of price action, in terms of the volatility, particularly off the back of yesterday's CPI print, and taking obviously a deep dive into, I suppose, the price action next week as we start to get the full filter through of earnings season starting to develop for Q4. So obviously October figures for obviously last quarter. So we have to reflect that into the price action because, of course, if you're trading the likes of indices, we do have to be cognitive of the element of earnings season and how that can affect the volatility of these indices as well. So that throws an additional parameter of volatility into these markets as well. So if we look at yesterday's price action, broadly speaking, we can see how we had that very, very strong reactive move off of yesterday's CPI. So we had volatility in both ways, and we'll take you through the price action now very, very shortly. CPI, the core CPI, excluding food and energy, came in higher than expected, which is obviously a negative for stock markets. The headline CPI, which incorporates all elements of consideration, came in slightly lower than expectations. So, of course, yesterday, algos, market makers had that very, very clean sell-off from 1:30 right through till about 2:30, 3 o'clock, when we start to see a little bit of a bottom coming through and a very, very significant reversal. And actually what happened yesterday is we had liquidity makers taking both highs and lows simultaneously. Now we did have to factor in obviously the CPIs. We do have call options expiries as well to take into consideration. So we're seeing volatility on both sides of the coin. And this is where the idea of being nimble and being very, very reactive to the dynamics that play within the market. So whether you're trading shorter time frames, should I say, medium or even longer time frames, you want to be building that kind of clear, cohesive trade management plan, and obviously being able to not being too greedy when you get sufficient profits, being able to bank a proportion or all of those to obviously allow you to continually growing and developing your account. So that is something that we kind of adhere to. We recommend at the end of the day how traders trade is solely and entirely down to them, but we want to help them maximize their performance as best they can. So that obviously brings us then into today, where we had Chinese CPI figures overnight. Chinese CPI figures came in pretty much as expected at 2.8%. So consensus was 2.8, the actual figure was 2.8. Month-on-month figure, instead of being narrowly weaker, actually was slightly higher. And of course, the PPI has come in less than expected. So the producer price index is obviously better. The month-on-month slight increase, and of course the broad year-on-year CPI for China has come in pretty much as expected. So we're not seeing a massive movement there. Now we are seeing markets sell off. We have seen a lot of turmoil news developments in the UK this morning, particularly with rumours of the UK Chancellor being sacked from his position. And of course, if he does get sacked, that is only going to put more pressure on the political climate in the UK, but also, of course, UK-based assets like obviously the pound, and of course the likes of the FTSE 100 Index as well in the UK. So this afternoon, we do have import-export pricing indexes, and we do have retail sales coming out also. So we do have a number of data prints coming out of the States this afternoon. Now, of course, my perspective is, given the volatility we've seen yesterday, how is the markets going to close today into the weekly close? We've had tremendous vol yesterday, which we'll be showing you shortly, but it's just about trying to put some sort of clarity on the price action that's currently taking place. So as we look at the price action, first things first today is we're going to take a quick look at the yields. And yields is a story that we've been following very, very closely over the last number of weeks, both globally, European, UK, and of course in the US as well, and Asia. Now, yesterday off that 130 bat, obviously with the initial move, we had a real rapid increase in dollar strength initially. So dollar strength pushed through this area here around 113.50, creating that initial impulse. And yields did likewise. Yields broke through that 4% level, coming as high as around about 4.8%, which again shows the volatility associated with these in additional asset classes. Now, off the back of that initial dollar swing, we did, of course, get that initial break of structure on dollar pairs. So euro dollar, anything that had a risk association against the dollar obviously went lower. So euro dollar went lower, Aussie USD, Kiwi USD, pound USD, even the likes of gold as well, all snapped lower very, very quickly. So the initial impulse was very much, as we know it, as risk off, risk aversion, and getting out of those riskier assets and hedging into safer asset classes. Since then, we had that, I suppose, very, very sharp reversal. So we had that very, very sharp reversal in the yields in the dollar. So up here around 113.60, 113.80. very quickly eroded, very quickly faded back in, and actually completely sold off. And again, that's more to do with market makers and I suppose the banks and institutions getting involved in price action rather than just the initial impulse off of algos as well. And that is something to be very, very cautious of when and being mindful of when you're trading around high volatile news and fundamental events. Now, what's happened since then was that kind of massive recovery in euro dollar, and we had a very, very strong recovery in the cable. So yesterday afternoon we had this kind of, now the pound has been very, very volatile in its own right over the last week or so, couple of weeks in fact, and we have seen the cable obviously rally through. Now of course with the dollar pullback today, so this obviously movement in dollar strength overnight eroding back into this previous range has meant euro dollar, that initial bullish swing yesterday has eroded, and of course we're seeing the same thing in cable. Cable's obviously pulling back as well. Gold too is also pulling back. So we're seeing very, very choppy, very, very sharp movements in these indices, in these asset classes, all asset classes, not just the stock market. So you do have to be kind of adaptive to that. Gold, obviously very, very sharp sell-off yesterday, flagged all the way back into the range. Didn't quite get to the order block area that I was looking for around 1674. That would have been an interesting area of interest to keep an eye on. We did top out around about 70, 71, and we've seen the markets obviously drift off from there. We've broken through the previous consolidation where we'd held between Monday, Tuesday, Wednesday, and the market is turning south again. So gold is a little bit on the back foot today with the volatility that we're seeing. Now, whether that continues into the close, I think that will very much be dependent on the price action. Watching the price action very closely, getting clarity. If you're using higher time frames, looking at those higher time frame candle closures or price action structures to give you validation. And I think that's ultimately what's important here. In the cable, obviously with the fundamentals this morning, rumours circulating, and of course commentary, we have seen the pound slide. We've gone back from this kind of 113 level of optimism. We did break structure this morning through the short-term consolidation, did get a short-term recovery back into 113 and has been consistently selling off through the day. At this point in time, would I be massively surprised if cable got back into this area down here or even down here? Absolutely not. And given as well the consolidation, we've been very, very whippy back and forth. Massive short-term break of structure. We flagged up into this region and now we're flagging back into this region where we traded from the end of last week, very, very beginning of this week, where we saw Tuesday's lows, Wednesday's lows this week. Markets have done the midweek reversal yesterday and is now selling back into these areas of interest into this week's close. So cable is a very, very interesting one. Euro dollar, as we know, is moving lower. So we've taken the lows on the liquidity, we've taken the highs. We are now flagging into the origins of yesterday's move. Now, again, I think this area around 96.80, 97 is going to be interesting into the close. And of course, assessing this dollar strength. Does this dollar break through this area here and continue progressing higher? Or do we hold this level into the weekly close? And I think that's going to be the big determining factor, dependent on whether these areas break or whether they hold, and just being able to rationalize that into the price action. Now, in addition to the yields and dollar situation and obviously gold, we are looking at oil prices as well. So if we look at oil prices, broader macro trend has been very, very clear now. Last week, we talked about OPEC and that kind of the recovery in the oil prices from 76, 77, all the way back into this 90 region. On the daily time frame, should I say, we did get a daily order fill right into this 92, 93, actually 93 level or just below 93. Daily order block has been met very, very cleanly here. So effectively what happened was we took obviously bearish price action into lows. We flagged back up. We took out this short-term area of interest here, flagged back all the way into this order block level. And we have seen a very, very clear rejection back into the high 80s. So that's even alone in the last 3-4 days or so. Gold has sold off around about $5-6, which will help next month's inflation figure, because obviously the lower the energy prices goes and everything else, obviously the lower CPI will go as well. So it'll be very much determined to see how does the gold price or the oil prices react, given we've seen that order block rejection here off the daily at 93 region. And if we look at the kind of the short-term perspective, if you focus at that 93 area, we had consolidation. We've seen markets ultimately break lower. We did get obviously that pop yesterday. And of course, on that stronger dollar play today, oil markets are actually trading a little bit on the back foot. So I suppose this region here around 86.5 to 87 is going to be key, because if this gives way, the likelihood is then we're going to see that further decline. We do have a gap close down here to fill between 80 and 81 from the end of September. So that was September month end into the beginning of October. So just be mindful of that as well. We could see a cyclical reversion if the price action starts to break down even further That then brings us to the I suppose the stock markets, the indices. Very, very volatile move yesterday across the board. So in the S&Ps, this is where we were kind of trading throughout the week. We were kind of grinding lower, albeit holding this region. Complete snap through on the S&Ps. We talked about it yesterday in our Discord group. 3,500 did hold marginally, and then we got that reversal back into the range. Broke back underneath where this initial selling wave impulsed from. So this was obviously impulse, flagged back in, took the highs of the liquidity, and flagged all the way up, taking the highs of the week. So we've taken Tuesday's highs, we've taken Monday's highs, and the markets have obviously progressed through. Now, from this perspective here, it's interesting to see how does the markets react off of this region. Now, short term, we've obviously been flagging back down to retest this area here in 36.50, but the broader mechanics here is, do we get a little bit of a relief rally into the close, back into this kind of 3580, 3600 level? And I suppose that's going to be the interesting factor today, because if we do get that pullback, it's going to allow for maybe a run up even higher. So that, I suppose, is the determining factor. But of course, 3700s here, I think, is the invalidator. If we're taking out 3700s, that will allow for probably another pop higher as markets continue to reverse after Thursday's very, very choppy move in the CPIs. And this is a similar theme across the board. In the Nasdaq, we had that consolidation all week. We had that very, very sharp breakdown, flag all the way back up. It's the common theme you'll see across the board, taking out the highs of the week. So Tuesday, and even here as well on Monday. So these were the Monday highs. This is the shorter term price action. We actually broken through the highs as well. Notice how we've just marginally broken through the highs, and now we're back underneath the range. So we've taken lows, we've taken highs. It'll be interesting to see if there's one more swipe lower before we actually get it through aggregated move. In that determined, it's just a case of watching the price action to get clarity and structure on where the price action is looking to go. Similarly, again with the Dow Jones, so this was a key daily level here around 28,650, 600 daily area from last week, October lows. So this was the consolidation region all week. We broke through, got into the lows, very, very sharp snap back. And of course, what happened from there, markets back through this range here of interest, very, very quick pop, and actually has taken out the highs of the week. And now we are actually testing the highs from last week, or the beginning of October highs up here when we had that runoff just before NFP. So last Tuesday week, 6th, 7th of October, these highs before we had NFP is where price action is currently testing. And of course, if it's a case we're taking out this high here, the likelihood is now the next Fed meeting is the start of November, 2nd November. Would it be surprising to see the markets rally into that November 2nd Fed meeting? Let's wait and see. That would probably be the bias by institutions. But of course, from a retail trading perspective, let's keep an eye on that mindset or scenario as well, just to see if that develops. The volatility was definitely rife in the US yesterday. We saw it across the board. It wasn't just solely immune to the US. We did get it across the board. So yesterday, DAX came all the way down to this 4-hour order block area here at 12,000. We had that initial consolidation, kind of like the DAX, kind of like the Dow Jones with the daily area. We got that move down to the daily area, and we got a subsequent bounce on the DAX here as well. We had consolidation with the initial breakout we talked about earlier in the week. We got that pop, got the pullback back into the 4-hour order block. So the institution's very, very clear liquidity moves here off of this one. Back through the short-term consolidation from Monday's highs, and now trading back into this 12.5 region. And of course, now it becomes a case of, well, are we going to see another pop higher? Are we going to see kind of 13,000, 13,100? Well, I think the narrative for that would be markets rallying, as I said, into the Fed meeting in the early parts of November. We're only a couple of weeks away. Let's just wait and see how the price action plays out, but wouldn't rule that scenario out in any way, shape, or form. Then, of course, with last but not least, we look at the FTSE. Now, of course, FTSE has the broader mechanics in the markets, but it also has its own internal, I suppose, issues to contend with, particularly off the back of Chancellor Kwarteng, of course, the Bank of England, which has now said that they will stop the funding of gilts today. And of course, how will that react to the markets? Because of course, institutions could come in with another bat of selling on the cable in the back of that. But FTSE, I suppose the big area this week has always been around about 6,800, that kind of weekly level. We talked about it on Tuesday in our pound preview, this 6,800 level. Of course, liquidity is the whole way down. And if we look at the shorter timeframes this week, massive move lower, impulsed, markets now holding well above. So 6,800 was always kind of the level this week to see how we close. We did temporarily break through it yesterday, but of course these initial moves can prove to be very, very temporary, and we can see a very, very quick change in a short period of time. And that's exactly what happened yesterday. We had that break, we had that impulse, took out the liquidity. If we look at the 1 hour charts, you'll see it. Took out this liquidity, took out bearish order flow, and is now rallied back up. So from that perspective, now it's interesting to see, do we get one last kind of bearish impulse into 6,800 before we see a kind of a modest recovery in the FTSE back into kind of 7,000 or maybe higher than that? I suppose that's going to be the interesting demographic or point of interest for the next week or so, particularly with the volatility that we're seeing in the pound at the moment, and of course in the UK market internally. So that's effectively what kind of where we are for the week. Everyone, of course, it's been a massive week for volatility. Those moves yesterday were quite crazy when you look at it in real time as well, which we were doing. It's quite stark and quite important to realize why the elements of risk management is so important, to make sure that you retain that idea of capital preservation and making sure that you limit the downside as best as possible, to making sure you have the best opportunity for success. So we're going to leave it there for the weekend, everyone. For the week. Have a lovely weekend, everyone, and we'll see you all on Monday, where we will be looking at the beginning of earnings season next week. So we will be looking at adding earnings season into these videos, just to kind of give people as much information as possible and have to make the best decisions as possible as well. All right. Thanks, everyone. Have a lovely weekend.